Realty Income stock has been beat down like crazy over the last year, but actually finally seems to be finding some support around the $50 per share price point. Now in this video, we're going to go through exactly why I think Realty Income will not trade much lower from here and why it's likely bottomed at least for the short term. On top of that, I'm going to explain why I've been buying more shares of Realty Income like crazy, and of course when I think that this monthly dividend paying REIT is going to take off. Now stick around, drop a like down below, and subscribe. Now let's get right into it. Now before we go over some more of the Realty Income fundamentals and why I think that this REIT is going to be just fine, even throughout this massive downturn, let's look at some of the most recent performance. So as of filming this video, Realty Income is down around 21% year to date, which is quite the drop and still trading towards the bottom part of the 52-week range. Now, like I said a minute ago, Realty Income has sort of been hovering around that $50 range now for a little bit. And in my opinion, I don't think Realty Income is going to trade much lower from here, unless of course we do get another rate hike. Now, looking a little bit closer to the Fed rate monitoring tool, for November 1st, it's looking like we are not going to get a rate hike. It looks like the majority of the probability is going to be that the rates are going to be paused, which is of course bullish for real estate and Realty Income. But looking out a little bit further, December 13th of 2023, which is the next Fed meeting after that, it looks like there's a 60% chance as of right now the rates are going to be paused, but a 35.5% chance that rates could be hiked. Now, because Realty Income is a REIT and it's in the real estate sector, it's still, of course, going to act very sensitive to any potential future rate hikes. And for good reason, when rates go up, debt's more expensive. And that, of course, hurts Realty Income's bottom line. But with that being said, I think for the most part, Realty Income has seen the most of the pain, at least unless rates go up from here or something major breaks in the system. Now, for this reason, I've been buying shares of Realty Income like crazy over the past few weeks, and I'm currently sitting across all my portfolios around 2,600 or 2,700 shares as of filming this video. Now, this is of course for me personally as an investor. I do have a long time horizon ahead of me, and I believe in Realty Income's fundamentals very strongly. And speaking of Realty Income's fundamentals, let's talk a little bit more about why I'm able to sleep well at night, with Realty Income currently being one of the largest positions in my portfolio. Over to the Realty Income website, it says right here, diversified delivers. We focus on acquiring and maintaining high-quality, single-unit freestanding commercial properties under long-term net lease agreements leased to leading global operators by curating an extensive and highly diversified portfolio. And that's exactly one of the reasons on why I personally am so bullish on Realty Income and why I've been buying so many shares of Realty Income over the last month, especially as it's been down. I'm a big fan of real estate, and I'm a big fan of high-quality commercial retail real estate, which Realty Income has the most of by far. Also, not to mention industrial real estate, when it's leased out to the correct tenants, could also be an absolute cash cow. But that being said, one of the biggest criticisms of Realty Income as of lately actually caught my attention, and I think there might be some validity to this. Now, if you look at Realty Income's top 10 industries, let's go through these together. It says convenience stores is at around 11% of the entire portfolio. Now, just to backtrack, keep in mind, Realty Income has around 13,000, probably close to almost 14,000 at this point, commercial properties that are leased to 1,300 different clients. So that's very key here, 1,300 different clients who operate in different industries throughout places like the United States, as well as other places. So keep that in mind. Now, convenience stores is 11%, grocery stores 9%, dollar stores 7%, home improvement 5.9%, drugstores 5.8%, restaurants, quick service 5.5%, restaurants, casual dining 4.8%, health and fitness is around 4.2%, automotive services 4%, and general merchandise is around 3.7%. Now, it's also important to mind, this is just the top 10 industries when it comes to Realty Income. They are currently leasing out to over 1,300 different clients. So just because this makes up a majority of all the industries, there's still going to be a lot of things that fall in between the cracks. Now, just one more thing before we go any further, looking at these different industries, especially in a time moving forward here, where there very well could be a sustained recession ahead. In 2024, or maybe even in 2025, who knows what's going to happen next. But if there is a recession, especially with being an investor into a REIT like Realty Income, I want to know who is actually paying rent to the properties that I'm investing into. Now, I don't know about you, but as far as the top 10 industries go, for the most part, these are what I would consider recession-proof businesses. Even looking back during 2020, during all the craziness, a lot of these industries actually did quite well. Things like dollar stores did well. Grocery stores stayed open and did very, very well. Convenience stores did also, and pretty much everything else on this list. Home improvement, general merchandise, even automotive services. Maybe the only thing that didn't do as well during 2020, for example, for reference, is maybe health and fitness. But for the most part, I would consider these industries somewhat recession-proof, which so far is pretty bullish for Realty Income. But now we get to the good part. Some of the actual concerns I have as even being an investor in this high quality REIT is the actual client diversification, and this is the top 20 clients. Now remember, there's around 1,300 different clients, but these are going to be the top 20 as far as this goes. So as far as the top 20 clients for Realty Income, we have companies like Dollar General, like Walgreens, Dollar Tree, 7-Eleven, EG Group Limited, Wynn Resorts, FedEx, B&Q, Sainsbury, and LA Fitness. Let's just go off of those ones as of right now. So a lot of investors are very concerned, saying that there's a possibility of some of these different top clients or top tenants of Realty Income. There's somewhat of an idea that some of these top clients could be even going out of business, which means, of course, Realty Income, being the landlord, if you will, is going to possibly be in some trouble. So a lot of people that are concerned about Realty Income are saying that, well, what happens if some of these top clients that Realty Income has as of right now continue to have problems and possibly even go out of business? Now, the first thing I'll say to that, once again, being a little bit biased because I do hold quite a bit of Realty Income shares, I will say that's honestly a pretty good point. Considering companies like Dollar General, Walgreens, even Dollar Tree are companies and stocks that I personally would not be buying right now or even want to touch with a 10-foot pole. But my response to that is pretty simple. Realty Income has over 1,300 different clients within the very diversified portfolio. Companies like FedEx, even Wynn Resorts, companies like BJ's Wholesale, Lifetime Fitness, Lowe's, and so on and so forth. These, remember, are just 20 of the top clients. So there's tons of different companies that Realty Income rents to on a consistent basis. And also, although historical performance does not indicate future performance, if we look at Realty Income's portfolio occupancy and see how much Realty Income has either dropped in occupancy or stayed the same over time. Looking back all the way back to 1992, Realty Income had a 98.6% portfolio occupancy. As of right now, the portfolio occupancy is around 99%. Now, of course, looking at during 2008 and 2009, when things got real bad, Realty Income's portfolio occupancy did drop down to 96% or so. But that being said, not all that long after, Realty Income's occupancy rate climbed back up and they got most of their portfolio rented in no time. Now, another thing to keep in mind, and this is a little bit over all of our heads, I'm sure, the leases that are worked out with Walgreens and Dollar General and some of these other companies that some people are concerned about when it comes to Realty Income, being the owner of the properties and leasing out to them, these leases most likely have guarantees that I think Realty Income will be just fine with. And on top of that, with the recent news of Walgreens, the pharmacy chain closing around 150 stores in the US and around 300 in the UK, does mean that Realty Income, along with every other commercial real estate provider out there, is most likely going to have some headwinds. But the reason I think Realty Income will be just fine is the fact that they are so over diversified, in my opinion, with over 1,300 different clients who operate all across the US and even the world in mostly what I think recession-proof businesses. And also keep in mind, if Realty Income owns a Walgreens and let's say Walgreens leaves and goes out of business and closes down their store, it doesn't mean that Realty Income can't lease out that old shell of a Walgreens to another client, or it doesn't mean that Realty Income can't just sell the land or whatever else. If we look right here, this is a screenshot from a debt summary as of June 30th, 2023, and this is from Realty Income's last earnings report. This is their current debt summary, so this gives us kind of an idea of where Realty Income is at as far as debt goes. So if we look through the list right here of all the credit facilities, unsecured term loans to senior unsecured notes and bonds and the mortgage payable, everything is broken down specifically. Total consolidated debt principal, $19.5 billion. Now out of this, there's a fixed portion and a variable portion. The fixed portion is going to be good. That means that the rate was fixed in before interest rates skyrocketed. And out of the entire debt that Realty Income has, at least as far as of the last earnings report, 92% of it is fixed, where only 8% of it is on variable. Now, even though 8% being on variable is not necessarily ideal because of course those are going to be much higher interest than of course the fixed. But looking at the debt summary, this gives you more of an idea of what Realty Income is working with when it comes to debt. So now that we went over Realty Income's fundamentals and some of the reasons on why this stock is going to be just fine in the future, at least in my opinion, I want to hear from you guys down below. First off, are you currently buying Realty Income at these levels? And number two, do you agree with me when I say Realty Income has pretty much bottomed from here unless we see some major differences as far as interest rates or a black swan event? Comment down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.